Welcome to Market Meridian Finance, your go-to source for clear, data-driven market insights. Over the next 4.5 minutes, we'll break down today's biggest market mover, the IEA's emergency oil release, a historic decision to stabilize global energy markets amid rising geopolitical tensions. For the past month, geopolitical conflicts in key oil-producing regions have roiled energy markets, sending Brent crude above $95 per barrel and WTI near $92. A 15% jump in 3 weeks. This surge has pushed inflation higher and forced investors to rethink interest rate expectations, with ripple effects across global economies. The IEA, an intergovernmental organization of 31 member countries, has authorized an emergency oil release, only the 8th time in its 50-year history. Early reports suggest 60 to 80 million barrels will be released gradually over 30 to 45 days, aiming to cool surging prices and prevent an energy crisis that could derail growth, especially in vulnerable emerging markets. The IEA's goal is simple: short-term supply increases to ease price pressure, driven by geopolitical tensions, strong post-pandemic demand, and limited spare production capacity. But why does this matter for your portfolio? Let's connect oil prices, inflation, and interest rates. Rising oil pushes up energy costs, feeding broader inflation. The latest US CPI rose 3.7% year-over-year, with energy accounting for nearly a third of that. This has shifted Fed rate cut expectations, once priced for multiple 2024 cuts. The market now expects just 1 to 2, likely delayed until late summer or fall. The IEA's release reinforces this higher-for-longer rate trajectory. This impacts key asset classes. Growth and tech stocks face pressure, as high rates reduce the present value of future earnings. Real estate also struggles, with high mortgage rates lowering affordability and slowing activity. Energy stocks may see short-term pressure as prices stabilize, but volatility will persist amid unresolved geopolitical tensions. Actionable insights for your portfolio. First, stay diversified to reduce exposure to market shocks. Second, avoid overexposure to energy-sensitive industries like airlines and manufacturing. Focus on defensive sectors like utilities and healthcare, which offer stable revenue and dividends. Third, prioritize companies with strong balance sheets and stable cash flow to weather volatility. Will the IEA's release work? It will stabilize prices short-term, likely between $85 to $90 per barrel, but won't solve underlying tensions or supply constraints. Volatility will remain. An OPEC+'s response, potentially production cuts, could offset the IEA's move. Global impacts are mixed. Developed economies get inflation relief, while emerging markets face both lower oil costs and Fed-driven capital outflows. Key takeaways: the IEA's release is a short-term fix, Fed cuts are delayed, defensive sectors and strong companies are favored, and volatility persists. Watch inflation data and Fed commentary for next signals. Before we go, tomorrow's key events: EIA's oil inventory report, Eurozone inflation data, and Fed Chair Powell's speech, all critical for market direction. Subscribe and turn on notifications for daily insights, and leave your questions below. Thank you for joining Market Meridian Finance. Stay diversified, informed, and focused on the long term. Happy investing!